Financials are the worst performing sectors in the S&P 500. Welcome to the show, one and all. I'm your host, JD Durkin. You're watching Taking Stock, moments away from the ringing of the iconic closing bell here at the New York Stock Exchange, and volatility reaching its highest level since early November, with the VIX on the day currently trading at a 20 handle. The 10-year Treasury yield reaching 4.31% earlier today here on Wall Street. That is its highest level, going all the way back to August 26th. The dollar in retreat, and meanwhile those safe haven plays really at the forefront of the mindset for investors, with gold and silver once again ripping to fresh all-time highs, silver reaching $92 an ounce. The crypto majors are all down in a big way. We'll talk a lot more about Bitcoin, ETH, and Solana in just a bit, but first we got the team from Off the Hook Yachts set to ring the closing bell. They will also be on the broadcast in just a bit. Time now for the bell. And the crowd here at the big board is fired up, and why not? The team from Off the Hook Yachts, ticker symbol OTH, doing the honors to bring about a close to today's trading session. And man, oh man, what a day it was. We'll take a look at the tail of the tape here on this Tuesday, January 20th, right about session lows for the S&P 500, which will sell off more than 2%. That's about $1 trillion in comparable total volume gone from the S&P 500 in a single day. The Dow 30 components down 1.7%. The New York Stock Exchange Composite Index, which had been notching all-time high after all-time high, is down 1.4%, and the small caps down 1.2 on the day as well. Oil benchmarks, WTI and Brent crude, both in positive territory on the day. And as for the Dow, you're really seeing that risk-off defensive rotation at the forefront, because your strongest performing names in the Dow, UNH, Coca-Cola, and Procter & Gamble, your three biggest laggards, 3M, IBM, and Apple. Meanwhile, advanced declines telling us momentum very much stalling and broad-based selling across the tape, and we'll bring you ongoing coverage throughout the half hour down here on the trading floor from the New York Stock Exchange. All right, time now to take a look at the latest event contract odds from our friends over at Polymarket. We'll switch gears. We'll talk a little sports here. How could we not? As Polymarket participants try and figure out who will be the Super Bowl champion coming up in just a couple of weeks. 39% chance it is Seattle, 27% chance it is the LA Rams, 27% is the New England Patriots, and only 7% for the Denver Broncos after that injury to Bo Nix. More than $600 million in total trade volume on this particular event contract. We get the AFC Championship game Sunday at 3, the NFC game Sunday at 6:30, the Super Bowl 2 weeks later. All right, time now to take a look at two NYSE notables before we toss to break. We'll start with 3M. This is one of the worst performers in the S&P 500 after reporting a miss on revenue and a disappointing profit forecast for 2026, dropping to its 200-day moving average on the technicals for the first time since last April, down so far this year, but up 10% over the course of the last 52 weeks. And finally, how about a look here at XLP? This is consumer staples. We mentioned it there a few moments ago. This is really the only sector in positive territory. It's been on a huge run since the start of 2026. The five most weighted stocks in this ETF: Walmart, Costco, Procter & Gamble, Coca-Cola, as well as Philip Morris. Investors really using this as a defensive go-to here on the day, away from tech into some of these more stable, cash flow heavy retailers. Shares of XLP are up already 6% so far here in 2026. We got a jam-packed half hour here on Taking Stock live from the New York Stock Exchange, but first we'll bring in the latest from our friends over at Money 2020 and their very own Scarlett Sieber. Take a look.
Welcome back to Who the F Knows 2026 predictions with me, Scarlett Sieber from Money 2020. Today's prediction comes from Charlene Tom, one of the amazing people on our Money 2020 Europe content team. Charlene says that 2026 is the year wealth tech becomes invisible. Let's break that down. A world where wealth management isn't something you actively do, it just happens. AI embeds investing into your everyday behaviors, portfolio update themselves, and advice pops up before you make a bad move. And with Europe's regulatory clarity, wealth tech finally scales and has this defining moment. Okay, Charlene, I see you. I like this one a lot. The idea of wealth tech becoming invisible, That's a whole vibe. Most people don't love managing investments, so if AI can make it seamless, that's a game changer. And here's the kicker, it's already happening. Robo-advisors like Scalable Capital and Nutmeg are growing fast, and embedded investing is creeping into super apps. Global robo-advisor AUM is projected to hit 2.5 trillion by 27, up from the 1.2 trillion in 23. That's some serious momentum right there. But let's look at the reality check for a second. Trust and adoption. Will people really let AI take the wheel on their money? Behavioral inertia is strong. Most investors still want some control, though. And regulation, Europe's MiFID II and AI Act are moving, but compliance timelines stretch into 26, 27, and beyond. So invisible wealth tech might not be fully mainstream by 26. It's more like a strong beta phase. So my verdict here will be bank on it. But this one does have a caution flag as well. The tech is ready, the demand is there, but mass adoption and regulatory harmonization will take time. Think accelerating trend, not fully invisible overnight. But what do you all think? Are we ready to let AI run our portfolios? Or do we still want to keep a hand on that wheel? Drop your thoughts and check the rest of our Who in the F Knows 26 predictions at money2020.com. Because in fintech, the only sure bet is nothing's guaranteed. See you next time.
Let's do it. Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. We'll bring in our first guest. This is Mark Newton, longtime friend of the show. Mark is Global Head of Technical Strategy at Fundstrat. Thank you for being here, and man, oh man, what a day for you to be here.
Quite a day, down 2% across the board. Unexpected, look, deja vu to April of 2025, and I think that's the key message. Unexpected news happens all of a sudden, stocks get shocked to the downside, but we don't really know what's going to happen. I mean, you look at the poly market odds of Greenland being taken over, a lot of these are in the 20% range, so really not all that dramatic. For me, it's more of a negotiation tool yet again, and it's likely a reason for investors to take a dip in and buy stocks after the recent breadth improvement we've seen in the last couple of weeks.
Yeah, I was going to say, at least on the technicals, how do you trade, how do you position all this uncertainty? It's Venezuela, it's Iran, it's strife with NATO over Greenland now, all at the same time that the president's soon going to be in Davos, where all of these issues will be at the forefront, and we'll probably hear a lot more things that could move the markets in just the next 72 hours.
Look, investors have actually gotten a little more optimistic in the last couple of months. That's interesting and different than what we've seen. And so despite what we think is a world falling all around us, if anything, investors have become a little bit more emboldened. I don't think it's reached speculative type fervor yet where it's true complacency, but I do think it's something to watch out for. Keep in mind, look, in the last 2 months, we've seen breakouts to new all-time highs in Dow Jones Transports, the equal-rated S&P, small caps, mid caps, Dow. All these have moved up. The breadth has actually gotten a lot better. So yes, of course, anytime you see a 2% decline, you think the sky is falling, it's the end of the world, but bottom line, there's a lot of sectors that are working really, really well right now. The only thing it's not, of course, is Mag 7. So we need to see some stabilization in these large cap companies, you know, the largest technology companies in the world, and that will be important, which I think will be earnings season, obviously, for why technology can start to roar back to new highs.
Oh, let's talk about technology. MAGS, that's the main Mag 7 ETF, you say recently breaking a support level, and that's, if I'm not mistaken, that was coming into today. So
yeah, no, we're still in look, you look over the last few months, we've been almost nowhere. It's been almost unchanged, and I think the key message here is, you know, these things go through patterns of rampant acceleration followed by meaningful consolidation, and we're in one of that time now. You know, NVIDIA gone nowhere in 6 months, Palantir nowhere. Meanwhile, you look at Expeditors, you look at JP Hunt, all these transport companies are just screaming to new highs. Not today, of course, but in general, they've been doing quite well. So you have to know what to own, and in some cases, the areas to find the alpha isn't necessarily in technology in the near term. So you have to look at, as I said, look at parts of healthcare, look at transports, look, the broader industrial space looks phenomenal. I think small caps have been outperforming large caps, and that's really the key message here for investors.
Midterm election year, seasonality, choppiness, so we do historically hit a couple quarters here. It's the weak spot of the 4-year cycle.
Yes,
we have no idea how things are going to go. We have all this bullish setup to the year. We have to be reminded anything can happen in a midterm election year.
I do suspect this is going to be a year of consolidation. I don't think we rip for 4 straight years higher. I am bullish on the year overall with a 7,300 target, but I don't think it's going to be a straight shot. My own guess in technical studies with regards to sentiment and cycle suggests late February, early March, we start to pull back. We bounce into the summer, we have a third quarter drawdown. That's probably the low and we rip up into 2028. But I think it's going to be, look, tech got too extended, and now we're starting to see that already, where these companies and the stocks are just going nowhere. So it's going to be a broadening out, and we're seeing that already. That's a good sign. It's not going to be an earnings-led recession, so to speak. It's going to be just tech falling from very overbought levels. It's going to create, I think, an attractive buying opportunity for investors come fall.
Just about out of time before we let you go. What do you like out of emerging markets ETFs and any emerging markets ex-China ETFs?
Yeah,
right
look,
now?
it's been a phenomenal space, and now you see evidence of the dollar really starting to roll over as a result of this news. So that's going to be good for emerging markets in general. I would look at the LATAM space. You look at ILF, the Latin American 40. It's been a phenomenal outperformer, breaking 15-year downtrends. Not only is it Brazil, but you look at Mexico, you look at Argentina. You have to look, of course, at South Korea. It's got one of the best earnings pictures of any of the emerging markets this year for 2026.
For sure.
And yes, that is technology, but it's already very overbought. I would look at South Korea, I would look at the LATAM space, and yeah, eventually I think India and China start to come back.
All right, we'll have you back soon. Mark Newton, thanks for being here as
Thanks,
always.
JD. Yep.
Don't go anywhere. Much more Taking Stock coming up after this. Let's do it. Welcome back to the show. Time now for the latest headlines you need to know in the world of fintech, crypto, and artificial intelligence. First up at this hour, as we mentioned earlier, all the crypto majors down in a big way on this trading Tuesday. Bitcoin down 3%, ETH down almost 6%, and Solana selling off 4.7%. Next up, OpenAI says its annualized revenue crossing $20 billion in 2025, more than tripling 2024's figures. This as user growth and computing capacity continue to surge. And finally, a big announcement from the New York Stock Exchange this weekend, developing a blockchain-based venue that would allow tokenized stocks and ETFs to trade around the clock with real-time funding and settlement pending regulatory approval. Let's now bring in John Herrick. He is the Chief Product Officer right here at the New York Stock Exchange to talk all about what is undoubtedly a huge announcement for an institution that goes all the way back to 1792, but always trying to evolve, always trying to stay on the cutting edge of new technology. What does this announcement actually mean, John?
Well, thanks for having me, JD. It's a very exciting announcement for the NYSE, and I think it really signifies a key pivot point in the modernization of our modern market infrastructure. And I think if you look back and how things have operated and sort of the fixed trading hours, fixed settlement cycles, funding cycles, this really signifies a key pivot point for really us to bring in a number of market participants who want to innovate using some of these newer digital technologies in a way that preserves regulation and upholds issuer and investor protections.
John, how are you most expecting this will change the trading and settlement process overall?
Well, when you look at what we're building with this platform, it's really the first steps at overhauling the plumbing of the market. And when we look at our broader strategy across ICE, right, there's a lot that we're doing with our digital strategy to take these new, more modern on-chain technologies and help bring them to our clearinghouses, for example, to help make collateral more mobile and free up some of the capital that's in those clearinghouses. This venue is an extension of that. And I think what we're doing by bringing trading and settlement into one single platform, one single venue, we're going to be able to offer to these regulated market participants a place to begin to develop native digital solutions for their customers in a way that doesn't require the erosion of any of the embedded protections that exist in our markets today.
Yeah, without a doubt, I'm sure you and the entire team at the exchange and ICE, you've seen that there is retail investor appetite for these type of products. What do you think might most change for retail investors in this new look future?
Well, when you look back at how the demands of today's investor have changed over the last several years, right? A lot of that has been driven by, some of the innovations that have come from the digital asset marketplace and decentralized finance. And so when we look at today's investor and what they're demanding, they're really looking for continuous round-the-clock access to trading. And the features like being able to do a trade and have it settle in real time is becoming more and more in demand, and a more modern user experience from a trading perspective, being able to express an order in notional dollar terms that results in a fractional share quantity are really things that are in demand for today's investor.
How are you thinking about the regulatory landscape over such a huge, exciting announcement like this, the CFTC, the SEC, and any other acronym that may be involved here out of Washington, D.C.?
Well, when you look at what we're trying to accomplish here, and really all that we do here at the NYSE, we recognize that trust is paramount in our markets, right? Without trust, we lose so much that we've developed over our 200+ year history. And I think when we look at what we're trying to accomplish here, it really is responsible innovation, preserving that trust, working very closely with the regulators. We've had tremendous dialogue with the SEC, with the Crypto Task Force, Trading and Markets, and market participants that are interested in coming into this platform to, as I said earlier, begin building products for the future, products that are more digitally native, that their clients are demanding without losing any of the protections that our markets carry with them today.
John Herrick, Chief Product Officer here at the New York Stock Exchange. Congratulations on a huge industry-shaking bit of news over the busy holiday weekend. Thanks for joining us.
Thank you for having me.
Good to have you. Folks, don't go anywhere. Much more Taking Stock coming up from the big board after this. Let's do it. Welcome back to the show. Time now for the headlines you need to know in the world of startups, raises, and rounds for your Tuesday afternoon. First up at this hour, Andreessen Horowitz pouring more than $3 billion into AI infrastructure bets, setting aside an additional $1.7 billion for investment in artificial intelligence startups. Next up, AI coding platform Replit reportedly in talks to raise about $400 million at a valuation nearing $9 billion overall. And finally, European satellite operator Eutelsat signing a multi-launch deal with French startup MayaSpace to send low Earth orbit satellites into space beginning next year, 2027. This comes as Europe moves to challenge SpaceX and Starlink in the global satellite race. FinTech TV's very own Remy Blair sat down with Linwood Bibbins. Linwood is the CEO and founder of Reach TV to celebrate the debut of this very show, Taking Stock on Reach TV. Take a look.
Well, joining me here at the New York Stock Exchange is Linwood Bibbins, Chairman and CEO of Reach TV. So, talk about some of the trends that you think have momentum and you're watching as we head into 2026.
Well, I think obviously you hear the buzzword of AI and you see all agents and those type of things. They are extremely important to efficiencies and getting places. But what I was very happy to see and really became a theme without being a theme was that they're a tool. Human connection is the key. And I think that connection is going to be the new luxury in 26. That is one thing that it was really clear. The other thing is, and I'm going to give credit to Shelley Palmer. This is going to be the year of distrust, and what I mean is, every time you see a video now, you don't know if it's AI or not. That's the trust part I'm talking about. Not that they don't believe things. It's you're questioning everything because you don't know if it's AI, if it's real. And so what we're gonna have to do is find ways to make that obvious and clear to people. And I think that's why the in-person is gonna be the new luxury.
Yeah, and Linwood, I'm glad that you made that distinction, right? Because when we're thinking about the headlines that have been coming out of CES, there has been a focus on autonomous driving and some of the humanoid robots I'm sure that you saw on the ground in Vegas. So, moving forward, given the fact that artificial intelligence will touch all industries, all areas of business, what does it actually mean for Reach TV's audience?
Well, for our audience, I mean, we are the traveler. We're a travel entertainment company. Our focus is on the traveler and their journey. So when there's automation and things that can help our travelers, we're all for it. We're bringing it together. But when you see it as a replacement, you can't replace connection. You can't replace going to go see family. You can't replace going to enjoy a vacation, and you can't replace in-person meetings. So I see that corporate offices are back in. Look at New York. Everybody's back to work 4 days, 5 days a week. Now you're going to have people going corporate travel. So again, for our industry, we're probably the one industry where you need that human person, where it's really about the bartender at the airport. It's about the lounge. It's about interacting with people throughout that journey to get you through. So it's the one place where I don't see the humanoids being able to actually replace right now. We're years upon years upon years away from it in this space. And this is a space that everybody's coming through. So we're seeing it as an amazing opportunity to keep activating. We're activating it in airports and filming every week. So how do we keep that momentum going and how do we bring you together and have some fun? Right? So have really cool, fun stuff, airport fits, airport eats, like really fun, cool lifestyle shows that really bring us all together.
So, finally, before I let you go, taking stock, the program we have here at the closing bell, we are bringing that to Reach TV audiences across the country
Yes.
starting in January. So, tell us your take on this and what it means for all the viewers out there.
I mean, you got to look at the fact that, like I said earlier, we see corporate travels back. So our job is to entertain, inform, and educate people that are already traveling in an airport. That morning, what we're doing right now is extremely important. And then guess what? After that day of travel, they come back to the airport and they want to know what's going on. Close Bell. These are the things that as a business owner and a traveler, I want to know what's going on, what stocks are happening, what's trending inside the market. And these are extremely important information for travelers, for us, for everybody in the ecosystem.
Well, absolutely. It's going to be an exciting year as we head into 2026. So always great talking to you, Liv. Was great having you here at the New York Stock Exchange. Thank you so much.
Welcome back to the show. Time now for what is always one of my favorite segments, not just speaking with an incredible guest, but a guest who just rang the iconic closing bell. Say hello to the man himself, Brian John. He's the CEO of Off the Hook Yachts. I have done so many interviews in my career here. Might be the coolest name for a company I've ever heard of. Welcome to the big board. Nice to have you.
Great to be here. Appreciate it.
What was the experience like ringing the bell? And give us a bit of an introduction to Off the Hook Yachts for anyone a bit unfamiliar, Brian.
So it was absolutely fantastic to ring the bell. Off the Hook Yachts were the largest buyer and seller of used boats in the entire country. So we set the market for used boats. We're like, think of the Kelly Blue Book for used boats. That's us.
Yeah, go ahead.
So very momentous for us to go public. Because we went public, we were able to access capital, which the company's never had before in its 13-year operating history. It's always been organic growth, profitable every year for 13 years, but, begging for Peter to pay Paul. And because we went public, we raised $15 million, and that was able to give us the ability to increase our floor plan, which is our line of credit we use to buy boats with through a bank, from $25 million to $60 million, which we announced this morning, which was huge. So big day for the company.
Yeah, and this was a big down day writ large for the broader major market indexes, but I'm taking a look here at the stock, and Off the Hook Yachts up 3.4%. Talk to me a bit about kind of growth strategies and what you think 2026 looks like for the company, Brian.
Yeah, we'll continue to grow like we have. We put out guidance every quarter. People can sit on our quarterly earnings calls if they want that information. I'm not going to give guidance on this interview, though. So, but yeah, the stock's starting to react well. Unfortunately, we put out some fantastic news today. We also got our first research report was written by our bank, Think Equity, today. You should take a look at that. It calls for a $10 price in 2026, which was released by them today. So big day for us press-wise and company performance-wise, but unfortunately, like you said, it came out in a day when the market's down 700 points. So hopefully over the next couple of days, we'll see some reaction to our good news.
Yeah, fair enough. I know you're here in town for the New York Boat Show, which is going on at Jacob Javits Center. Give us a bit of an introduction to the work that you and the firm are doing here at the Javits Center for anyone a bit unfamiliar.
Yeah, basically, so we focus on new boats. I'm sorry, we don't do new boats. We focus on used boats and used boats only. So we're not at the boat shows advertising boats for sale. We go to the boat shows because we're like the Manheim for the boat business. So we take all trades from the dealers. So we roll around the boat shows more or less to meet brokers and to meet other dealers that we can take trades from and buy boats from.
About out of time, any tailwinds you think that most support pre-owned yacht demand in today's ecosystem and environment?
Well, unfortunately, it's an inverse relationship. Usually when new boats are doing not doing so well, which has been the case for the last couple of years, we excel during those times because they only have so much room on their floor plans. They only have so much room to put boats in their lines, and 3 or 4 deals have a trade. So what do you do with those trades? You sell them to us.
The ticker symbol OTH, the company Off the Hook Yachts, the CEO, Brian John. Congratulations on everything. Thanks for joining us. Welcome back.
Thank you.
Come back to the New York Stock Exchange.
Absolutely.
Anytime. We got about 30 seconds or so here, folks, to wrap the show. Tomorrow here on Wall Street, we will get quarterly results from a handful of key Dow 30 components. That includes Johnson & Johnson as well as Travelers. We'll also hear from Halliburton, among many other names, tomorrow morning before markets open. In the afternoon, we'll hear from some smaller and regional banks. That includes Pinnacle Financial Partners. You may remember last week we had their CEO, Kevin Blair, down here. And at 10 a.m. tomorrow morning, a half hour into the start of the trade, December's pending home sales crossing the wire. That's going to do it for a wild day here on Wall Street. Thanks for watching, and we will see you again tomorrow.